Okay, so Tesla reported earnings yesterday and jumped some 10% plus into the after hours and held that run into today's market session. For context, Tesla stock is down some 35% year to date and some 60% from all-time highs reached in 2021. And quite frankly, I mean, the earnings report itself was pretty damn bad. It made for some pretty awful headlines like Tesla profits dropped 55%. And this comes at the same time as outlets have been reporting that Tesla is laying off thousands and thousands of workers. However, at the same time, Musk gave some hope. He said that cheaper models are coming on an accelerated time frame, something Wall Street applauded. He also teased an upcoming catalyst that will be, quote, the biggest asset value appreciation in history, which many are taking to suggest that the next wave and the next uptrend in Tesla stock is coming right around the corner. So in today's video, I want to break down rather violently what all of this means, what it means for Tesla stock, and how you can make money off this. And of course, as always, if you're the one taking the risk, you got to be the one doing the ultimate frisk. Lots of people, they get real risky before doing their frisky. And before we get into it, a full disclaimer here, we did alert Tesla puts for ZipTrader options members back on March 22nd, and those ran some 89% to highs as of a couple days ago. They were a powerful way to benefit from the downtrend in Tesla stock, a stock that routinely has massive dippy-dippito bear cycles and then massive rally-rallito cycles. Which, by the way, if you want our options alerts and our step-by-step video lessons on how to trade options, well, we do have a flash 200 coupon code, which will get you $200 off ZipTrader options membership. Coupon code down below. Let's get to work here. So let's talk earnings report. We're going to start with the earnings. You look at the deliveries, Q1's estimate was at 449,000 and some change. And, well, Tesla came in well under that at under 400,000. And this was the worst quarter for deliveries in the last 5 reports. Total automotive revenues dumped 13% when comparing Q1 2024 to Q1 of 2023 from $19.96 billion to $17.378 billion. But the drop is even worse when comparing that Q1 to Q4 of 2023, going from $21.563 billion to $17.378 billion. That's actually about a 19% drop from last quarter's report. Now, you had some picking up in the energy generation and storage revenue as well as services and other revenue sources. However, these are such a small portion of the overall revenue, and they don't make up for the bigger picture, which means that net you saw revenue dump 9% year over year and total gross profit dump 18% year over year. On top of that, the gross margin is continuing to crunch. Captain Crunch over here. Operating expenses are climbing dramatically year over year. Income from operations more than cut in half. Operating margin crunching, adjusted EBITDA down 21% year over year, adjusted EBITDA margin again crunching, Captain McCrunchy. Net income gap and non-gap cut about a half, EPS gap and non-gap cut about a half, net cash provided by operating activities down about 90%, capital expenditures, the expenditures of the capital up 34%. Free cash flow down by 674%. And in terms of one of the only good comps we have year over year, well, cash and cash equivalents are up about 20%. Now, in terms of how this report fared versus analyst expectations, well, Tesla missed on EPS by 9.1% and on revenue by 4.29%. So overall, folks, rough quarterly report to say the least. And there's a few clear reasons why markets still rallied on this report, which we'll get to a little bit later. But first, why are these year-over-year trends so bad? This is something that you really got to be understanding if you want to understand the deal with Tesla stock right now. Well, one reason is Tesla reduced their vehicle's average selling price year-over-year, which is crunching revenue and crunching profit margins. Another reason is the Cybertruck also was extremely expensive and time-consuming to get off the production ramp. Another reason is the updated Model 3 had a very slow, gradual ramp itself that delayed overall production. Tesla also reported an arson attack at the Gigafactory over in Berlin, and really Tesla's also seen some industry headwinds as Tesla reported themselves that global EV demand is down, and I'm sure the higher interest rates aren't helping too much either. But overall, if you do a little bit of digging, you find that there's one major reason that Tesla's numbers are looking bad right now, and that's because of the phase that they're in. They're in a capital expenditure, a investing in their business stage. If you read through the reports, Tesla right now is focusing on deploying capital into R&D and their overall infrastructure. From their earnings slide, it says, quote, while many are pulling back on their investments, we are investing in future growth, including our AI infrastructure, production capacity, our supercharger and service networks, and new products infrastructure. infrastructure with $2.8 billion of capital expenditures in Q1. And they say they earmarked about $1 billion specifically for AI development. Now, $2.8 billion in total capital expenditures for network and AI and so on and so forth may not sound like much for a company that was once valued at over $1 trillion. But when you're going and you're comparing the net income of Q1 of 2024 of $1.129 billion to last year's $2.513 billion in net income, it makes a big difference. I mean, you cut half of that $2.8 billion in capital expenditures, and all of a sudden you have an increase in net income year over year and not a decrease, right? So if they had just simply not deployed that capital into capital expenditures, well, all of a sudden the report would show an increase on many metrics that analysts are concerned about. So that means that if you're getting into why Tesla is rallying right now, it's because investors are looking at a stock that has been decimated, and at the same time, they are privy to the idea that this was simply a scaling up, investing, and building year for Tesla. This was a year where they had to invest a lot of money in order to scale up for the next phase. Tesla, since inception, has gone into different eras where all of a sudden they had to invest tons of money, things looked bleak, and then all of a sudden they had a massive win, and then back to things looking bleak and investing tons. And that goes over and over again. Right now, we're in that investing tons bleak stage. But in terms of accomplishments, Tesla is already reporting. Tesla increased AI training compute by more than 130% in Q1. They reported record energy storage deployment of 4.1 gigawatts. They produced over 1,000 Cybertrucks in a single week in April, which is that's a pretty damn big accomplishment considering how hard these things are to produce, which, by the way, my grandma thought these Cybertrucks were electric garbage trucks. I had explained to her that no, they're not garbage trucks. They're revolutionary trucks. In terms of other accomplishments, they increased supercharger connectors by 27%, supercharger stations by 26%, mobile service fleet by 12%, Tesla locations by 26%. You're also seeing a pretty exponential climb in cumulative miles driven with their full self-driving beta and their Tesla AI training capacity. So again, when you're looking at the overall report and you're saying, wow, that report looks pretty damn shiny, well, again, you're comparing this year over year in a year where they're basically just investing in their business model for future growth waves. And the rest of 2024 will likely continue to be one of those growth years. From the report, quote, our company is currently between two major growth waves. The first one began with the global expansion of the Model 3/Y platform, and we believe the next one will be initiated by advances in autonomy and introduction of new products, including those built on our next generation vehicle platform. In 2024, our vehicle volume growth rate may be notably lower than the growth rate achieved in 2023 as our teams work on the launch of the next generation vehicle and other products. In 2024, the growth rates of energy storage deployments and revenue in our energy generation and storage business should outpace the automotive business. So here they're saying, hey, we're focusing on the next stage for our automotive business, and we're also scaling our energy generation and storage business and services business. But what is the next big growth wave for what is still primarily their main business, which is the car business? Well, they said, quote, we have updated our future vehicle lineup to accelerate the launch of new models ahead of our previously communicated start of production in the second half of 2025. This update may result in achieving less cost reduction than previously expected, but enables us to prudently grow our vehicle volumes in a more CapEx efficient manner during uncertain times. This would help us fully utilize our current expected maximum capacity of close to 3 million vehicles, enabling more than 50% growth over 2023 production before investing in new manufacturing lines. Okay, so here they are basically saying that they are accelerating the launch time of their cheaper models and teasing that this next growth wave is really going to start a lot sooner than expected, or at least sooner than expected before that mid-2025 originally planned production date, which this is something that analysts in Wall Street love to hear because that's where they really see the next wave of money coming for Tesla. Okay, now let's go ahead and talk about the Musk of Elon. So Musk suggested that investors look bigger picture once again by insisting that Tesla is not a car company, and if you value it as such, you're going to be missing the bigger point. Here's what he said verbatim, quote, we should be thought of as an AI robotics company. If you value Tesla as just an auto company, it's just the wrong framework. If you ask the wrong question, then the right answer is impossible. So obviously nothing new from a rhetoric standpoint from Musk. We've heard this before, but what he's really gearing investors towards here and saying this on the earnings call is that, hey, wait, look a second. This earnings report was bad, but you're valuing the company wrong if you're criticizing us for this earnings report where we're literally just investing in scaling up and doing what our mission has always been. Now, critics will say that he's trying to shift focus away from the bad performance and onto all of these other pie in the sky stuff. But if you look at all of the other times throughout history where he's done this tactic, usually he's right. It's just on a delayed time frame when the results start pouring in. And what he's really gearing investors towards here is this event event that he calls the biggest asset value appreciation in history. And of course, what he's talking about here is the long-awaited full self-driving and building an overall autonomous fleet of cars. Now, again, he's been talking about this for a long while, but they continue to make progress, and this continues to be closer and closer to reality. Here's the full quote on what he said, quote, "The way to think of Tesla is almost entirely in terms of solving autonomy and being able to turn on that autonomy for a gigantic fleet. And I think it might be the biggest asset value appreciation in history when that day happens, when you can do unsupervised full self-driving." Now, in terms of the next big catalyst on this, well, Tesla will be revealing the robo-taxi on August 8th of this year. They're saying this is going to be purpose-built, which many are taking and speculating to mean that it's going to lack traditional driving controls, such as steering wheels or pedals, and specifically just serve as an autonomous taxi, which, as investors look at this and see that roll off the lot and start seeing regulators decide whether or not they want to approve it in their localities, well, that's going to provide a lot of opportunity for rallitos and a lot of risk on capital to pour back into Tesla. They previewed an autonomous ride-hailing app. Now, obviously, if you were buying Tesla for robo-taxi or autonomous fleet predictions, you're going to be waiting a while for these to become really, really mainstream. But the bigger point here is that Tesla has painted a picture quarter over quarter that we're getting closer. And really, as their full self-driving beta miles exponentially increase into the billions and the Tesla AI training capacity continues to skyrocket, it's just becoming more and more plausible that this is going to become a reality. Now, at the earnings Q&A, a Tesla investor asked, quote, "What is Tesla's current assessment of the pathway toward regulatory approval for unsupervised FSD in the US, and how should we think about the appropriate safety threshold compared to human drivers?" And this is his response. Listen very carefully here. It's quote, "It's actually been pretty helpful that other autonomous car companies have been cutting a path through the regulatory jungle. That's actually quite helpful. And they have obviously been operating in San Francisco for a while. I think they got approval for the city of LA. So these approvals are happening rapidly. I think if you've got at scale a statistically significant amount of data that shows conclusively that the automotive car has, let's say, half the accident rate of a human-driven car, I think that's difficult to ignore, because at that point, stopping autonomy means killing people. So I actually do think that there will be significant regulatory barriers provided there was conclusive data that the autonomous car is safer than the human-driven car. And in my view, this will be much like elevators. Elevators used to be operated by a guy with a relay switch, but sometimes that guy would get tired or drunk or just make a mistake and shatter somebody in half between floors. So now we just get into an elevator and press a button. We don't think about it. In fact, it's kind of weird if somebody is standing there with a relay switch. And that will be how cars work. You just summon the car using your phone, you get in, it takes you to a destination, and you get out. So here Musk made a very convincing point to argue for why regulators are going to be very, very, very much compelled to eventually approve autonomous vehicles, because it's a public safety risk if they don't. Now, arguably right now, it's a public safety risk to completely approve them. As of today, it seems like they're still far more dangerous than regular cars, but at some point, once they start really racking up those billions of beta miles, all of a sudden that whole game is going to change. And we're in the process of that happening right now, and that's what Musk is portraying here. And then he later goes on to argue that we're going to see some 7 million cars in a year or so, and then eventually tens of millions of cars by the end of the decade, which will have this capability. So in summary, Tesla had a bad quarterly report. They projected fairly poor guidance, expecting even lower volume, but Tesla also said this was going to be a building quarter and a prep before the next growth wave. They also reported significant progress on many different areas of their infrastructure and software development as well. So overall, the summary takeaway here is this is a building quarter before the next growth wave, which should be expected to happen sometime at the end of this year or in early 2025. Now, in terms of Tesla stock and my thoughts on it, well, I think that this uptrend is likely not going to lead to a broader reversal just yet. I believe that markets are a bit more risk averse right now, and we are in a stagnating range even in some of the companies that are reporting huge year-over-year profit growths and huge revenue growths. So I would argue if this run lasts for a week or two, it's just going to end up getting bludgeoned again, and the real dip by cycle and recovery won't happen until later this year, or maybe right before that widespread production of the cheaper models starts happening. So my take with Tesla stock is probably you're looking at a Q4 2024 rebound or a Q1 2025 rebound. I don't believe the rebound that you're seeing right now in Q2 is going to last long. I think you're probably more likely than not just going to be stagnating within range until you get to Q4 at minimum. So what does that mean for you now? Well, it means if you like the stock, accumulate it at good deal prices and simply wait and hold. And if you're a trader and the technicals suggest another downtrend emerging, maybe trade puts. If you need help spotting ideas on Tesla and other stocks like our massively winning Tesla puts, make sure to join us in ZipTrader Options with coupon code FLASH200. As a member, you will get access to our step-by-step video lessons that will teach you how to trade options A through Z, and you'll also get access to our private chat and our alerts, which we send out usually every single day, and they're all very well thought out and strategically placed and timed. So anyways, that caps off today's video. We'll see you in the next one.